Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Oana.
So first of all, I want to thank all of you for being patient the last couple of weeks that we haven't done a video.
Okay.
We've been extremely busy, probably the busiest we've been in a long time.
That's true.
A lot of stuff going on. Eventually, you will find out about it. But right now, we're not going to talk about that. We're going to talk about the housing market.
Okay.
Okay. So what we're going to specifically talk about in this video is what the housing market will look like in 12 months. And what's fascinating about this comes from data that was aggregated from two groups of people, investors and prospective home buyers, because they're really the ones that will drive the next 12 months of purchasing. And what's fascinating is this company went and grabbed all this. They polled a ton of people and they got this information. And we're going to go through here. I'll put a link to this data so you'll be able to go through the whole report. Okay, so there's two groups of people, investors, all through the investing vertical, own a couple houses, own a bunch, but no institutional investors. Okay. And then consumers, people who are considering buying a house.
Okay, so speaking of investors, I have a shout out.
Okay, shout out.
So today I got to meet one of the investors who listens to and watches our video. So hello, Ray Gallagher. It was very nice to meet you in person.
Oh yeah, and I didn't get to see you there, Ray, because I was gone. So at a property, it was at a property, right, or something.
Yes.
We just ran into him. Okay, so we're going to start with the first. We're going to put up the first slide. We have a ton of slides. I think I have about 20 slides, so you have to be patient. But if you're a real estate geek and you watch this channel, then you're really going to like all the slides. Okay. So on the left, you see the real estate investor panel and the questions. On the right's the consumer panel. Okay, so the question they asked specifically is, how would you describe the U.S. housing market? And it's weak, neutral, strong, or don't know. Okay, 12 months ago, they asked him, how did you feel 12 months ago? Most people said that the housing market was strong.
It was. 12 months ago, it was strong. 12 months ago, interest rates were still 3%.
Okay. Now, if you look at consumer, now this was a real investor said, if you look at the consumer panel, they felt the real estate market was weak 12 months ago. Very few, actually about half of them felt it was either weak or neutral.
Interesting.
But investors felt it was extremely a strong market. That's the highest you could give it, was strong 12 months ago. What's fascinating is if you go to today, it's changed substantially. Now about over half of all investors says it's weak or neutral. And then if you ask them in 12 months, most feel that it will be weak. And then some think strong and some think neutral, but most think weak in 12 months. What's really fascinating is the consumer panel, their opinions are almost identical 12 months ago today to in 12 months. Why is there a difference? And we'll leave the chart up while we talk about it. Why do you think there's a difference between investors having a substantially different view versus consumers?
So I think investors have a much longer view because of their cycles, right?
Okay, so consumers. Okay, so investors have a longer view.
Right. So consumers are more looking at the short term. And I think investors are looking at a longer term.
Okay.
So I think that's part of it. Because remember, an investor is going to purchase the property today, and he's going to have to do maybe some renovations. Maybe he's going to rent it out and then sell it. Maybe he's going to go ahead and flip it. So whatever that investor is doing is going to take a longer period of time. The consumer is basically looking at a 3-month window, okay? Because if they're looking at buying or selling a house, they're usually looking within a 3-month window.
What about, let's talk about people that are watching the video. We know that they're predominantly males, 75%. And we know, hi guys. And we know that there's a lot of investors, a lot of investors. Most of the people we meet that come up to us, we do get people that say, hey, we bought a house. But by far the people that are running us down in public are saying, I'm an investor, I buy a bunch of houses. How do you think they're watching videos, reading the news, it drives what they think? Because remember, these are just people who are investors versus people who are consumers. They're people. They're not institutions or anything like that, but they have these substantial different views a year ago, today, and a year from now.
Right. So I think you're dealing with, I mean, if you're looking at gender, because I think that's where you're driving this question is you're looking at gender, and I think if you're looking at gender, I think maybe it has to do with the way males are wired, that they're more wired for data, they're more wired for risk taking, and that sort of thing. Females, by and large, are not wired in the same way. And that doesn't apply to all of us because clearly I'm an investor and I pay attention to all these things. So there are females out there like me, but I would agree with you that males, by and large, tend to be more willing to be risk takers and be investors.
Okay. Now we're going to go to the next slide. What's fascinating about this slide is it a good or bad time to buy slide. Mm-hmm. Now, investors and owner occupants have roughly the same answer, bad, neutral, or good. Mm-hmm. What's fascinating was that the investors think that in 12 months, it will be a better time to buy than it was 12 months ago. Even though they are more negative about the market, according to this, they think it'll be a good time to buy, over half of them. Right. Where only about 40% of them said 12 months ago was a good time to buy. Only about 20% now are saying it's a good time to buy. Over half of them are saying in 12 months that'll be a good time to buy. Now, do you think it's because they feel that prices will drop in 12 months and it'll be better time to buy than now?
I think so. I think that they're looking at, because remember, investors are not necessarily sensitive to interest rates. If anything, interest rates are helping them. So kind of to your point, when I met Ray Gallagher today, we were at a property that I have listed for a client, and who was at this property were multiple investors, okay? And they were looking to purchase this property. And I think investors are looking at this, and because they tend to be cash purchasers, they are using interest rates in their favor. Okay. So what I mean by that is they're saying, hey, Mr. Seller, buyers can't buy your property or are not willing to buy your property because of the interest rates. And so I'm willing to buy it, but I want a discount. And I think investors are seeing that going forward now and for the next few months. And I think that they're looking at basically the next 12 months as the time when they're going to make money. Because remember, making money is on the buy side, not on the sell side, right? Okay. Because they're looking that they can buy these properties right, meaning for a discount now and over the next 12 months. And then once interest rates are either normalized, whatever that means, or people give up on waiting for interest rates to go down, then people will come back into the market and these investors will be able to sell the properties and make a tidy profit. The other thing that they're doing is they are renting them out because, again, rents have been pretty stable. Tenants are still in need of properties, and so they're making good money. And because they're not borrowing the money to purchase these properties, they're getting a good return on investment. Okay. So if for example, let's say you're buying a property for $400,000 and maybe you're getting $2,500 in rent, that's not a bad rate of return. So that I think that's what's going on. I think that's what the investors are looking at. Okay. We've got rent data where they actually ask them what they think is going to happen with rents. That's actually fascinating data that we're going to talk about. But I want to ask this question, and we're going to move on to more slides because I still have like 15 more slides to go through. Okay. You're an investor. You believe that you might get a 5% better deal on a house, or maybe 10% better deal on a house if you wait a year. But then maybe you're giving up 7 or 8% of rent for the year. Mm-hmm. Here's the question. Do you roll the dice and hang on to your cash, or do you try to acquire the house now and then go ahead and rent it so you can start collecting rent and getting a return on your money? Or do you wait, and then what happens if the house prices don't change and you end up having to compete with owner occupants again? Mm-hmm. Now that's the trick. That's why everyone wants, people say, they ask us, is it a good time to buy, which we always say, well, it depends, because it depends on a lot. This is in the stock market. Like, when is Tesla going to bottom out so I can buy some more Tesla stock, right? This is completely different. So how does that work? How do you think the average, because most of the people buying your listings now are investors. Yes. It's really interesting. I've been very surprised by that. And what's particularly surprising to me is that it's kind of the same cast of characters. So I put a property on the market, and chances are that I'm going to get an offer from multiple investors, and chances are that at least a couple of those investors I've either gotten offers from before or closed transactions with them recently, not ages ago, but like maybe within the last 12 months.
Okay.
So it's really interesting. It's the same cast of characters, and I've never had that happen before. So this is kind of new and exciting for me because it's a different trend.
Next slide here, mortgage credit availability. On the left, investors, what they believe, and on the right, owner occupants. What's fascinating is owner occupants don't believe that it's changed much from 12 months ago today to 12 months about getting not interest rates, but their availability to get credit. However, investors are pessimistic. They believe that it's going to be worse in 12 months than today. They'll be more difficult to get mortgage credit. Now, we don't know if this means for them or for the average person, because maybe they think that it'll be harder for them as investors to get, if they're buying a property with a mortgage. So what do you think they are more pessimistic? When this data was taken, the Fed had just raised interest rates by 0.7 or 75 basis points, 7.75%.
So it's interesting. So I don't know. I mean, I think maybe investors are also concerned about interest rates because obviously not everybody's buying cash. So I think that maybe that's a possibility. On the consumer end, I would be more concerned as far as consumers are concerned because consumers are acquiring debt. Remember during the pandemic, consumers were sitting on the most cash ever. They had the most savings ever. Those savings have now been extinguished. They are accumulating debt at a very rapid rate. So I would think that it's going to become more difficult for consumers to get a loan because of other debt that they're carrying.
The next one is trajectory of home prices. This is based on what they believe. Now, if you ask them about 12 months ago, pretty much everybody, consumers and investors, said appreciating. And of course, we all know that because we have a year of hindsight to look at. When you look at today, it's more mixed. But when you look at a year from now, the investors are still pessimistic. They think that most of them think home prices will be declining. But then when you go to consumers, most people are flat or appreciating. Now, do you think that will affect their purchasing decisions if they believe home prices will be going up in a year, that they'll go out there and start purchasing again while maybe investors will back off? Because we know investors aren't backing off. They're buying right now.
Right. No, investors are not backing off. Consumers have more trepidation, I think, at this point, but I think they are concerned that interest rates will continue to increase and that they're better off buying sooner rather than later and not paying the higher interest rates that they feel will invariably happen in the next few months.
Now, this is the rent one. Trajectory of rents. So they were asked, do you think rents will be declining, flat, or appreciating? What's fascinating is the consumers almost overwhelmingly believe they'll be appreciating, that rents will go up. They all believe rents will go up. Investors, even today, almost only a couple percent felt that rents would decline. And even less than 20% said in a year from now they'll be declining. Most, about 80%, said flat or appreciating. So there's this belief. And of course, we have inflation, which is something that it tends to make rents go up. So we have rising rents, or the belief that rents will rise, which is going to make people take a certain action, maybe purchase a house, possibly, because they're trying to avoid the future rent increase, right? And they want to lock in that payment today, even though interest rates are higher. But it's fascinating that even consumers and investors both, almost none of them believe there'll be declining rents in 12 months.
The only way you'd have declining rents is if you had excess supply, and that hasn't really been the case. I mean, there are certainly plenty of homes on the market to rent, but not so many that we're seeing rents go down. So I agree with that. And the other thing is just historically speaking, rents are either flat or they go up. Very seldom do they go down.
The next question was how they felt the economy was. And the specific question was, would we be in a recession? And of course, today, about investors are a little more pessimistic about the future, and consumers are a little more pessimistic about now, because they ask the question today, 12 months and 24 months.
Mm-hmm.
And most people felt either now or in 12 months we would be in recession.
Mm-hmm.
And then when you go out to 24 months, it's less than half of them felt we would be in recession in 24 months.
Yeah, I think a lot of that is because of past history. And what's happening globally is, again, such a unique set of circumstances that none of us have a good historical model to use as a window into the future.
Right.
I mean, look, what's happening in Ukraine is unprecedented as far as, we've got nuclear power threatening Ukraine. We've got the whole NATO thing. We've got just all the turmoil that's happening economically, globally. There's just so much going on that you'd have to go back almost 90 years
Right.
to something similar.
Mm-hmm.
So I don't think people's memories are that long.
Yeah, I agree. Okay, this is sort of fascinating table here. So what they did is they took people who felt like the health of the real estate market was weak, neutral, or strong,
Mm-hmm.
and then they asked them the rent trajectory, significantly declining, flat, appreciating. So you can see based on how they felt, how they thought that rents would do. What's interesting is the people who felt that the housing market was neutral or strong were more inclined to think that rents would rise, and then the people that and that home prices would rise, and then the people who felt the housing market was weak felt that there would be a significant decline or declining. But what's most fascinating is that the consumers, who are the people on the right-hand side, were more neutral, that it would be flat, and the investors were more negative,
Mm-hmm.
declining or significantly declining.
So I think it's a matter of what information people are looking at and their time horizons, and we've kind of talked about that. So I think that investors are interested in a broader range of information, and that consumers are more myopic about the information that they're looking at.
Okay. The next slide here was the good time to buy based on the same factors. Is it a good time to buy? And they said bad, neutral, or good. Mm-hmm. And then whether they felt home price trajectory would be declining or increasing or flat. And we have the same relationship. The investors who thought it was a bad time to buy felt that home prices would be declining. And the consumers who thought that it was that were strong, that was a good time to buy, felt overwhelmingly that home prices would be flat or appreciating. So it's like people's beliefs drive their intentions, like their actions and what they are going to do based on what they believe.
It's about, whatever you believe, it makes it a self-fulfilling prophecy. And we know that certainly in the U.S., consumer sentiment drives our economy.
Right. Yeah. The next one is economy, prices, and rents in the next 12 months. So this is 12 months in the future. And of course, on the left, you have the investors who overwhelmingly felt that the house price trajectory would be declining if we were in a recession. And the people who felt the economy would be growing thought home prices would be anywhere from declining to appreciating. But what was interesting was that the consumers, home purchasers, felt that home prices, even though the economy was slowing, the rent trajectory would be flat or appreciating. Mm-hmm. Even though the economy is slowing, that's what they believe. Now, these are people that are potentially going to buy, like, are you going to buy in the next 12 months?
Right. Yeah, but again, because historically rents either are flat or increase. Very seldom do rents decrease. I know that, I've been doing property management for a long time, and when the economy gets tough, we don't reduce rent, we just keep it the same.
Right. Yeah, you almost don't have to reduce rent.
No, we don't reduce rent.
So are you seeing that right now? Right. Are you saying when the tenant's year is up, they go, hey, we want you to knock $50 off the rent?
No. You know what? I've never seen that. anytime that anybody has even broached that subject, the answer has been, we appreciate that you're a good tenant, and to that end, we're not increasing your rent. But we don't reduce rent because it's very difficult to raise rent in the first place. So then when rents start to go up rapidly, we can't keep up with that, because then that's not fair to that tenant. So if rents
Right.
go up 30%, we're not going to raise your rent 30%.
Right.
So we can't keep up with that. So we want to make sure that whatever rent increases we do keep pace with the rest of the rents in the neighborhood, without having to raise the rent for an existing tenant to an exorbitant amount in any period.
And you have to be fair to the whoever owns the house.
Yeah.
Because you can't just say, well, we don't want to raise the rent because they're a good tenant, but then, they're getting shorted in their rent. The next chart was how they felt inflation's prices and rents would be in 12 months. We sort of have the same effect here. Investors who thought inflation would be accelerating were more likely to think home prices trajectory would decline. But then consumers felt the opposite. They felt accelerating inflation would push home prices higher. So you have two different thoughts here. Investors say if we have inflation, home prices will drop. But then you have consumers who are saying if we have inflation, home prices will go up.
Well, and I'm with the consumers on this. I don't see any reason why home prices would go down with inflation. I mean, we didn't see that in the past. When we had
No, we didn't see that.
When we had 18% interest rates, when we had skyrocketing inflation, we didn't see home prices go down. So historically speaking, I don't see why that would happen. I mean, obviously it's possible, anything's possible, but I don't see that happening. As far as the investors are concerned, I don't know what's causing that thought process on their end.
Yeah, I don't know either. So what they did is they put all these into these other charts, and you can see the averages. So the 12-month home price change, the average was that they would be down 5% in 12 months. Home prices would be down 5%. Now, there were people that said they would be up 25%, and there were people that said they would be down 25%. But home prices, they felt would be, on average, the average person, when they averaged all the numbers, they would be 5% less. Now, remember, it's the whole country. This isn't just Vegas, right? The rent change, though, the average, was they'd be up about 3% year over year. So they said homes would be 5% cheaper in a year. Rents would be up 3%.
And that doesn't sound out of the ballpark. Those numbers are so they're relatively small, so that's certainly possible.
Okay.
But, the thing is that, like I said before, there's just so much going on out there, and as far as geopolitically and politically here in the U.S., it's a very turbulent time, and that makes for very volatile markets, and we're seeing that in the stock market. We're seeing that with interest rates, and housing is this really big ship,
I know, yeah.
and it's certainly being impacted by all of this, but I think it's a hard ship for it to make a radical turn.
I agree. And especially when we have this overall shortage of properties in the U.S. We still haven't built for 13, 14 years straight the median number of homes over the last 50 years that we've been building. And now we have this phenomenon where home builders are reducing their new builds. So the housing stock on the back end of this is still going to be low. And we're going to be back in the situation where as soon as we get interest rates down again and these people come back to buy, we're going to go right back through this thing where home prices take off again. And nobody knows when that's going to happen, but it's not likely that it's not going to happen, because we know that we need more homes built and they're not building enough to satisfy demand, even though we have this goofy thing right now because interest rates are high.
But the thing with interest rates being high is people have short memories.
Right, because interest rates are basically where they were in 2004.
Right. So what I'm saying by that, people have short memories. So give them another year and they'll forget about the 3% interest rates, and all of a sudden, 7% is the new norm, and let's go.
I think I think by next spring, people are going to be pretty much done with all the bad news, and they're just going to be like, you know what, screw it, I'm going to buy. I don't care what interest rates are. I'll refi in a year or two.
Right. I mean, people have to get on with their lives. Look, we all have limited lifespans. We can't wait for Godot. Okay, we can't wait for interest rates to be what they were whenever. We're all getting on with our lives, and people will get on with their lives as far as home purchasing.
We're going to go through these next charts. This one's the good or bad time to buy, and they said in 12 months today or 12 months ago, and then you can see whether they said it was very bad, bad, neutral, good, and then you can see the percentages of of the and the totals for the people in different categories. But it's pretty fascinating to look at this, that you still have people that felt that it was bad time to buy a year ago and it would be better a year from now, because we know that looking back, you would have made money if you'd bought a house last year and sold it, even though you would have lost money because you would have paid the transaction fees of doing that. But people still feel that that consumers feel it'll be better in a year to buy from now.
Right. So here's what's going to happen. By the time people figure out that it's a good time to buy, the ship has sailed.
Right. The other fascinating thing is this mortgage credit availability. If you look there, that people feel that it'll be, no one thinks it'll be very easy in the future to get mortgage credit. But when you look at that difficult and neutral, that it looks like a lot of people still feel that it won't be that hard. It'll be difficult, but not that hard to get a mortgage credit today or in 12 months.
Right. I mean, I don't expect that it's going to be any more difficult than it's been as far as the lending rules are concerned. So long as you conform to the lending rules, it's going to be what it is. I think maybe where people are a little more concerned is because the interest rates are higher, their payments are going to be higher, so they're going to be maybe looking at a different price point.
Right. Trajectory of home price. This is another matrix. This breaks out everything very specifically. Of course, this is being mainly driven by the investors who believe that in 12 months they'll be significantly declining or declining, versus today where they're almost neutral. Like people think, half the people today said declining or significantly, but the other people said appreciating or significantly or flat. The
other thing I was just thinking about is that investors, I think, are burdened by a lot of noise. And what I mean by that is because they are active investors, because they are out there looking at properties every day, the whole perspective on the market is doing this all the time. So that's a lot of noise. And sometimes it's difficult to evaluate the trend for the noise.
The signal, to find the signal. That's actually the thing that tells them this is the long-term trend.
Right.
They don't really know. There's, between the stock market going up 2% day in and up and down, day in and out, crypto changing dramatically, interest rates changing dramatically. We have still seen specific markets where we're waiting for home prices to fall and it's not happening because the second anyone drops a price, the house sells. And there's still substantial shortage of inventory in certain markets. And then we have markets where like in Vegas, where inventory increased rapidly over a 3-month period, and then it's starting to level off now. And now people are trying to figure out, is that signal? What is that? Now, what that gonna look like in 6 months or a year? This next one, trajectory of rents. This is, I think, one of the most fascinating ones. Everybody, investors and consumers, people who are getting ready to buy, if you look at that in 12 months today and 12 months ago, that red sliver is significantly declining. It's literally zero, like a couple percent. And then declining is a small percentage. Overwhelmingly flat, appreciating, or significantly appreciating. These people still believe that trajectory of rent will appreciate, which sort of is, if you already own rental houses. So we talked about this. There were people who 6 months ago said, sell your rentals because the market's going to crash. List your house with me. so I can get the commission and put the money away, and then you're just stuck with the cash. Sell your house, right? Sell it before the market crashes, right? So they're giving that advice to people. We said, we're not selling our properties. We're not telling anybody to sell their properties because we see rents still going up and we'd rather have the money in our pocket. And we don't really care if home prices are down. Like and honestly, did any of our investors, did one come to us and say they wanted to sell their rental house?
Not a single one.
Not a single one. Because they all recognize we don't really care what the home prices are today. We don't want to pay capital gains taxes on it in this environment. We'd rather just wait and ride it out and keep collecting. Because who cares if home prices go up and down and up and down and up and down? If they've collected 7% per year, in 10 years they have 70% increase in their that they wouldn't have had with the cash just sitting in the bank. Plus they would get hammered on taxes. And I think that's what this shows is that investors think rents are going to go up. Prospective home buyers think rents are going to go up.
Right.
And selling your house, your investment house that you maybe have a loan on for 2 or 3% is the stupidest thing you could do because the home prices might drop. And we actually haven't seen that. We haven't seen a flood of people flooding the market with. We've seen some people sell, but people sell anyway. And what we don't know is, are these people that are selling, were they going to sell anyway in the next few months and they're just trying to get it out now?
Right. It's interesting because I woke up this morning to one of my investor clients sending me a message saying, hey, what's going on out there in Vegas? I'm ready to buy a house cash again. So
ready to buy a house cash again.
Yeah.
Okay.
So it was really interesting. So I had that this morning. Plus, I had the investors that were coming to look at my listing. So investors are out there, you guys, and they are active. It's not to overstate it, but it is, as far as individual investors, it's almost a feeding frenzy out there. It's really interesting.
So what is it investors know that a lot of people that are super negative on the market don't know?
I think investors are looking at their purchasing power dwindling due to inflation.
Okay.
And that's why they want to put their cash to work, because all these people that I'm talking with, they are cash buyers. They are not financing any of it. They don't care about the interest rates.
Okay.
They are looking.
So the fact that interest rates are 7% now, mortgage rates.
They don't care.
They don't care. They're like, who cares? We have cash. We don't care what. To them, this is an opportunity because a lot of their competition, who are the owner occupants, they've been pushed aside or pushed to lower price point homes, and they can come in and buy that $400,000 house that maybe was $425,000, and they can get it a bit cheaper. And
so remember, these are individual investors who were having a really hard time competing with owner occupants when the market was frothy. They were having a hard time competing with institutional investors. So now it's their turn, and they are not going to miss their turn, and they are out there in force. I have not seen this before. It's really very interesting to me.
This didn't happen the last downturn. The investors disappeared.
No, and
the flippers were gone completely.
Right.
In the declining market from 06, basically 07 to 09, they were gone because the market was declining for 2 years. And they were not really interested in trying to flip when they compete against the bank-owned homes. They would acquire something trustee sale. They just a lot of times would hang on to it.
Right. So what these guys are doing, or at least what I'm seeing some of these guys do, is they're looking at purchasing the property now.
Okay.
Doing some renovations in order to put a tenant in there.
Okay.
And then they're looking to hold the property for a period of time, and then when the market pops back up, then they're going to go ahead and consider, are they better off continuing to rent it, or are they better off selling it?
So is there a better use of their money than being in real estate, maybe?
Right. So right now they're just looking for somewhere to park their cash, because their cash is actually diminishing in purchasing power every day.
Okay. All of the numbers in this were taken over a broad sample of people all across the country. They're not in Las Vegas, even though we're specifically in the Las Vegas market. It's very fascinating data. You can, of course, everything we've told you is our opinion about what we believe, having sold over 3,000 houses, right? That we know, kind of understand how we've talked to hundreds of investors. and people who have, who just owner occupants who are selling their house and their reason for selling and what they believe and stuff. We talk to people every day who.
Right. And then look, if you are either an investor or a would-be investor, there are lots of meetups for investors out there. There are lots of clubs wherever in your local market. Lots of groups. Go to their social events. Go to their nights when they have speakers, and mingle with other investors and see what's going on in your market. Particularly if you're not familiar with your market, maybe you only have 1 or 2 investment properties, or maybe you don't have any and you're just looking to get involved. There are lots of those groups out there. The internet's a glorious thing. You can find them out there. We've attended a lot of those meetings, and we always meet really interesting people.
Yeah.
So
who've watched our videos.
Some have watched the videos.
Yeah.
So we enjoy meeting people like that and learning from them and getting different viewpoints and finding out what they're seeing in the market that's different than what we're seeing.
Yeah. So once again, we apologize for taking some time off here. We do have more videos coming out. We'll have another video that comes out tomorrow. I do have foreclosure numbers that we'll be putting out during the week. We'll be doing another market update here in about a week. So make sure you subscribe, hit the notification bell, like the video, share the video, leave us your comments, and we will see you on the next video.
Bye.
Bye.